Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, May 2nd, 2016. In this video, I wanted to touch on the precious metals and mining sector, and I'm going to start that out with an overview on the dollar because they are, at times there's a disconnect between the two, but for the most part, a falling dollar benefits gold and a rising dollar hurts gold, especially as priced in US dollars, which the majority of those following the site trade gold with. So now let's take a look here at the dollar index chart. I just covered this recently, stating my views. I've maintained a longer term bearish outlook for the dollar for quite a while, stating that the dollar's been in this trading range now for about the last year and a half. This goes all the way back to the beginning of 2015 here. You can see down here. And I've stated that this is a powerful consolidation zone. The dollar's just traded sideways in this range, and my belief is that the next definitive break below or above, by definitive, I mean you have to watch out for these brief, you can see that candlestick shadow right there where we had a brief breakdown. I'm talking a breakdown and preferably a weekly close or at least an impulsive move if it's just 2 or 3 daily candlesticks above or below that level. And I still favor downside resolution for reasons I've mentioned and I'll touch on now. But I am expecting, as I mentioned last week, some near-term upside. In other words, at least one more little bounce here, as we haven't visited this level in quite a while. And from my experience, usually the first test of a key support or resistance level that occurs in a while. In other words, we've had 1, 2, 3 visits down in this area, but we haven't seen the bottom of this zone all the way going back to August of last year. I'm sorry, August of 2015. That's correct, August of last year. And so this is the first tag in quite a while. And at the very least, I'm expecting a reaction. I also pointed out the other day when I did my analysis on the dollar, this bullish falling wedge pattern defined by this white downtrend line and this white downtrend line here. We had flat line or bullish divergences in place, a slight upward sloping trend line here on the RSI, as well on the MACD. And so what we've seen so far is a breakout. And I had mentioned before, my expectation was that we'd go up here, but I also, in the last video, I believe it was last week, was open to the possibility that we come down and test this lower support level, which is also pretty much, not an exact, we're slightly below it, a back test of this downtrend line there. And the dollar, this is an end of day chart I'm doing here. I'm looking at UUP right now. And it's trading down. It opened down and moved down quite a bit, but it's recovering and heading towards a break even on the day. We're not there yet. So again, something to watch. In other words, we have pretty much dual support, this downtrend line here, which we're slightly below, which is really a back test of the wedge following the breakout. So let's draw it out here real quick. And you can see, and most importantly, the bottom, the initial reaction of that support level. So if we got a bounce, I would be looking at a target probably up here to this yellow downtrend line at least. And ultimately, as I said, I still favor a downside resolution of that pattern. That would be bullish for gold, oil, other dollar-sensitive commodities. But if we do get this near-term bounce, this goes in line. I posted in the trading room. For the first time in a while, I've stepped aside of the mining stocks because the charts just weren't clear. I didn't see a very objective entry, had my concerns, but I did open my first a starter short position in Nugget, first short position in a while in the miners, and we'll see how that goes. I'll try to go over some targets in this video as well. All right, that's the daily chart of the dollar, and just to confirm my longer term bearish outlook, this is that same trading range shown here on a weekly chart that I just jumped to, a 10-year weekly chart. You can see the very strong negative divergence on both the RSI and the PPO that was put in at the second high here. That's powerful divergence after a heck of a run in the dollar. I know sentiment at the dollar at this point was through the roofs bullish, and that has longer term implications. But again, it's a trading range. You have to respect it either way. And maybe that downside break comes now. Maybe we don't get the bounce. And if so, then again, I'll list some possible stop areas on that GDX trade. And if I make it official, obviously I'll put up those charts and the official targets and stops. But I just wanted to share my thinking right now. All right, let's go ahead and dive into the charts. We'll start with the metals, and I'll wrap up with the miners because that's most important. There's gold. This is one of several charts that I have here. All in all, and I've maintained this all along, this was, a major support zone, target zone down here throughout the bear market. We were short right at the highs on gold, with a stop just above that level, never got hit. And I believe that officially was closed out here, so we wrote a bit of it down. And the bullish case had been setting up for a long time. The move off the bottom was explosive, and so far is covered. Gold broke out, consolidated. It was quite overbought at the point of the breakout, so it did have to trade sideways for a couple months to work off those near-term overbought conditions. And most recently broke out. I had pointed out this sort of flagging action here on the weekly chart, and we made an impulsive breakout. So by all accounts, on face value, that does seem bullish, and I can't take anything from that. However, I'm suspecting that there's not going to be follow through on that. Probably a pullback, and that's what I'm doing here is going over the reasoning why. Here it is on the daily chart. My comments over the last few months. I know there's been a lot of inquiries because my posting was, on the light side. I just didn't see a lot, and we were stuck in this sideways trading range for the last couple months, is in gold and the miners. The miners broke out first. I had my concerns. I stated as the miners broke out that gold hadn't yet broken out. And here's GLD. You can see that did happen. By breaking out, I'm referring to I was talking about these highs, the previous reaction highs back from March 4th. So gold did break out. A very impulsive. Look at the big gap, a follow through to the upside, and we're still above there now. So once again, on face value, that does look bullish, and that's what I was looking for. However, what gives me pause, if we look at that high compared to that March 4th high, this line right here, you can see we clearly have a divergent high. It's a little sloppy right now on the MACD, and the MACD hasn't curled down yet. We need to see a bearish crossover. So what I'm looking for, the short that I did today was a starter position. I need to see a little more evidence supporting this to bring it up to anything sizable. It's still adjusted my position down based on the leverage and everything else, but again, it's what I call a starter position, which I plan to add to, and I may even add on strength. We'll get to the GDX charts in a minute here. But one of the things that would help firm up that bearish case would be to see this breakout fail. In other words, the candlesticks over the last two trading sessions to move back below, get down into the gap, and if we get into the gap, we'll likely fill it. There's the top of the gap is the bottom of Friday's candlestick, and there's the bottom of the gap right there. Now, a gap backfill will have caused a false breakout. Prices would have moved back below the breakout level, which was that previous reaction high. So that's bearish technical event number one, if it happens. And again, these are things I'm on the lookout for. Pullback targets, I don't even have them listed now. There's a possible uptrend line in gold. But again, that's what I'm looking for now. And let's now move over to the charts of GDX. Try to keep this video relatively brief. All right, I've mentioned this recently, this very steep rising wedge. This is a bearish rising wedge pattern confirmed with, I shouldn't say confirmed yet, but it does have potential divergence. I like to use the term potential, and then I'll call it confirmed if and when the MACD rolls over here. You can see that blue line on the MACD. The MACD line is still pointing up. If and when that blue line comes down below the white line, which is a signal line, the 9 EMA, if it does so before making a new high, then we have confirmed negative divergence, and that will confirm the bearish nature of this wedge. The steeper the wedge, the sharper the fall. Sell signal number one, if you will. I'm getting ahead of this trade right now and anticipating a reversal for reasons I'll get to here in a minute. But the next sell signal would be a breakdown below that rising wedge, that steep uptrend line. And even a move back below that 2364 area will help. That was actually can have it, call it 2316 to be safe over that previous reaction high there. But either way, a move down there below that wedge and that horizontal level will most likely bring GDX down to at least that 2120-ish area. And it may not seem like much, but from this point, and again using the leverage of a dust trade, or nugget I should say, to capture the decay, excuse me. That's about a 17% drop. I was trying to grab that with the measuring tool. So a 17% drop in GDX. You can do the math on Nugget. But again, you need to position down because of the excessive beta or volatility in the miners, as well as a leverage. I just like to use Nugget to capture that decay. If this trade does play out, but let's just say my timing's a little off and it takes a few months to get there instead of just a few days or weeks like I suspect it might. All right, let's take a look now at some longer term things in GDX. This is a weekly chart. Here's a one trend line, only had a few reactions there. We've taken that out recently, but you can see just above that, this horizontal line, which comes in at 2763, that's pretty significant resistance, and we're not there yet. That's why I'm giving it a little more upside in GDX. You know, that would be about a little under 6%. Maybe a little less off yesterday's or Friday's highs, but we're almost there. Again, longer term chart, everything, confirmed this move. The outlook is still good longer term. It's just the near term that I'm concerned about here. Let's jump over to the Huey for a second. We'll do that because we can go back a little longer in time on the Huey. That's the Amex Gold Bugs Index, similar to GDX, but GDX as an ETF, it doesn't have 20 plus years of trading history. So we'll look at the longer term charts. So here's a trend line, a support line, I should say. I'm sorry, resistance at 234.28. That's where that level comes in. You can zoom in here. You can see the reactions here from above, how that area acted as support. Once that support was broken, the impulsive selling that validates that support line back then, former support, now resistance, I should say. You can see here prices tested from below for several weeks. And quite a few reactions, enough in my opinion to warrant that as a level to watch. And then not too far above, you have another resistance line, also defined by reaction highs, and then just above that, this downtrend line. So as I said, this is a bullet train right now, and I've had quite a few fingers cut trying to pick a top in the miners over the last couple months. So do your own due diligence and trade according to what you see and your risk tolerance. But I could see at best the miners pushing up to that dual resistance level there, the horizontal plus that downtrend line. And I'm betting we're not going to get there. Just looking at how extended, how extremely overbought we are, all the way out on the weekly time frame. And if we take a look at a monthly chart, this is the bigger picture for the Huey. That was a long-term uptrend line. This was a secular bull market in the mining stocks following a secular bear market. And this has been one heck of a bear market. The miners got really beat down and were, made a valuation case besides a technical case, coming into the lows based on where the price of gold was and oil and everything else. So this move, although caught myself and I'm sure a lot of others off guard of how strong it was. I mean, you can go back in time and you don't see many moves, but here's one. This is what I wanted to point out on long-term charts. Here's a near vertical run that went on for a few months, just like this one here. And I'll draw it out just so we know what we're talking about here. All right, grab a measuring tool or an arrow tool. So see that near vertical run? That's at least going back on this chart, which goes back into the mid 90s. That's about as strong a run as you've ever seen in the Huey. I mean, we've had moves here, but they weren't nearly vertical. They lasted many months to, strong runs. So obviously the trend is up. However, you get such a steep move, and then you had a nice pullback here. Let me clear those lines there. Get rid of this for a second so I can then grab this point here and just try to illustrate how much, if we do get a pullback, that was a 40% drop. And given it was only a blip on this strong monster bull run. So in a sense, I'm trying to pick up nickels in front of a steamroller on this trade. So again, you need to be nimble. You need to exit if you're wrong. Stops, as I said, can be quantified. There's quite a bit of resistance not too far overhead. Just make sure you sharpen your pencil and calculate what that will mean in dollar terms, depending on how much you put into the trade. I always say when I'm trading the miners, trying to use a 3, 5, 8% stop loss on them, even if you're not using the leverage ETFs, is almost you're almost assured to have your stops run before your profit target is hit, because these suckers go up and down. The mining index itself, unleveraged, can easily go up and down 5% a day, if not more. So, like I said, you have to allow yourself wider stops, larger profit targets, and the only way to do that without getting crushed if you're wrong is to adjust your position size down, where at the end of the day you'll lose the same in dollar terms if wrong, or make the same in dollar terms if right. In other words, if you're using a 15% stop loss or even a 20% stop loss, that would be an extreme. That's more for a longer term trade. But that works if you're targeting 50, 60, 70% or more is your profit target. Remember, it's all about risk to reward using a ratio. All right, enough on that. So there's the case that these suckers are not on the monthly chart, not overbought yet, but certainly on the weekly chart, weekly time frame at resistance. And I'll wrap this video up with one of the main reasons. Sometimes you don't get the full picture looking at only the chart of the sector, so I like to drill down to the individual components. And what I'll do is I have a related items list. This is all the holdings, or these are all the holdings of GDX, and I have these sorted by market cap. And I won't go through every one. We'll just look at some of the top names, starting with Barrick, symbol ABX. That's the largest as far as market cap, 20.4 billion in market cap. And here's a weekly chart. I'll just stick on the weekly time frames to keep this relatively brief. You can see this resistance level that we're at right now. There's that previous reaction high back in 2014. We had some reactions from above over there, and mainly I'm targeting that reaction high. And I think that Barrick, looking at as extended as it is with these extreme overbought readings, PPO is very stretched. Obviously, again, the momentum is upwards, but there's one that I think is due for at least a pullback. And at the most, if it punches through that level, we have very, very solid resistance here. This is on a scale of 1 to 5, we'll call it. That's got to be 4.5 or better. Numerous reactions following that big gap right there after the meltdown. If you can make it out, there's a gap right there. Very well-defined resistance at that point. And so we're at 1906 right now. Try to grab this. And that's so it's about 10% higher. So this is what I'm talking about on my stops. I'll call it 11.5, almost 12%. And that's about how much room, maybe a little bit more, I'm willing to give my trade. Now on Nugget, you need to multiply that by 3 to count for the leverage. But again, you're using a position size that's at least a third of what you would trade GDX, or at least that's how I do it. All right, let's just look at a few more. Make the case. This one, Newmont, one of the big leaders in the mining sector, very solid resistance. You can see this big gap back here. And remember, we had a similar gap on ABX. Those gaps are very significant. These are weekly charts. Those are huge gaps. And what I've done, the two horizontal lines show the gap. We're at the bottom of that gap right now. If we get into the gap, yeah, we likely fill it, but you can see in percentage terms it would be hardly anything. And then on top of that, we have the 38.2 Fibonacci retracement just above there. So here's the stock. Again, the story will be the same. Extremely overbought, a near vertical run. And, the corrections following these near vertical runs are usually just as quick. And that's all. Longer term, they still look good. I'm just looking for a pullback trade here. There's GG. Look at the nice downtrend line resistance. You can see here we're at downtrend line resistance plus horizontal resistance. And we go back on this line. There's several reactions at that level. So there's GG. Franklin, Nevada. Hard to pick apart this chart. Looks fine. AEM. I haven't marked this one up yet. I could put a line there. I won't put it as a solid resistance level. Let's throw up some fibs. I don't want to, I don't like to force things to try to make my case. It's not every single stock, but that's interesting. We throw up the Fibonacci retracements from the highs to the lows, and we're right at that 38.2 fib. A lot of traders incorporate fibs into their trading, so something to watch. Okay, and again, I don't want to go through them all. There's Randgold, longer term charts. You can see the nice wedge in that one looks good. Here's the stock at a key fib retracement, the 61.8 fib retracement. This one held up better than most during the bear market, but it's also at a key fib. So the theme here is the top holdings, if they're not at a major resistance level, horizontal, couple reactions there, I could actually add a line. I haven't marked up a lot of these charts in advance. You see what I'm doing? I'm capturing that reaction low, these reaction highs right here. That's where we're at. So again, on face value, I think a lot of traders are watching this, and I had this downtrend line here, and that is bullish, taking it out, and I expect to follow up in the coming months to years even. But ideally would be to see a back test here. This breakout, yeah, if there's such an extended run, we had a little bit of consolidation there. But I think it'd be healthy price action to see that one come back in, back test this downtrend line as well as this horizontal resistance level, and then take off. And at that point, if everything else aligns, that would be, where I'd be covering a pullback trade on Nugget right now. All right, we'll stop there. I think the point has been made. So again, the case is a near-term upside in the dollar, near-term downside in the metals and miners, followed by the longer-term bearish case on the dollar when we finally break down, if and when we break below that support zone, that trading range that we're in on the dollar. And again, as I've mentioned here, that longer-term outlook for the metals looks good. So, if this trade really works out well, I can reverse it. If I do get that pullback and gold, GDX, silver are all coming down to nice support levels, and it looks like the correction might be over, then I can reverse that and finally tuck away that dust short that I had planned to, back when we broke below the lows before this whole rally started. That was my initial intention, and I had a position there. I just tried to get crafty and took profits too early and then tried to catch a few tops. I just underestimated the scope of this move off the bottom. I should have touched on silver because that is important. One of the developments that I've noticed is, silver just recently broke out. We had this key downtrend line I was watching, and silver broke out, and that really gave fuel to the recent thrust up in the miners, and even gold followed suit. So this is what I was looking for quite a while, and it did happen. However, I have this, and I've had this target here, 1690. It's a pretty formidable resistance zone, and at the very least, I'm looking for a reaction off that initial tag there, meaning a pullback, and then ultimately we go on up through there. So that's a level to watch. So I also wanted to mention silver, although it did recently break out, I have it at pretty decent resistance. You can see it here. The previous reaction high, see this big fat gap from back in February of last year, reaction highs. So this line here, I should color code it, is a pretty formidable resistance level. And that's around 1692, call it 17. We recently punched up intraday, but fell back below there. So there it is. There's a case. Silver, as well as quite a few of the leading mining stocks, are at resistance. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.